In this week's video, we'll review the charts to help us answer the question, are signs of an imminent bear market piling up? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Stock market pullbacks and portfolio drawdowns can elicit strong emotions in humans, and we all know that trading decisions should be made as unemotionally as possible. Leveraging another quote from Market Wizards, take a theory and stick with it, but you also have to be open-minded enough to switch tracks if you feel that your theory has been proven wrong. Our basic theory is that the market, the S&P 500, has broken out of a long-term consolidation box. This is a bullish breakout, and we also have a trend change look here, a long-term trend change. Typically, when we see something like this, good things happen. This is our 30, 40, and 50 week, for illustrative purposes, only moving averages. And as of the close on Thursday, April 13th, keep in mind, the market was closed in the United States on Friday, April 14th. So all the charts that are dated April 13th are weekend charts. There's nothing on this chart as of April 13th that says our theory has been proven wrong from a long-term perspective. We still have a full-bore bullish look, and this looks like a strong trend. We know from past videos this is the look that we want to avoid. That's the low probability look. We really don't have anything like that on April 13th. Low probability look in 2008. Present day looks much, much better. Remember last week we talked about that the concept of a drawdown is pretty much inevitable when you're following long-term trends. And we pointed out in that video, throughout this volatile period here, the long-term trend, and this is the 200-day moving average, remained healthy for the most part from point A to point B. How about the S&P 500 over the same period? This is basically our entry point here, point A from last week's video, and this is point B. You can see the S&P 500 was also volatile. If we look at price, this isn't particularly easy in isolation. But when we add in the 200-day moving average, we can see for the most part from point A to point B, the long-term bullish trend remained intact. If the 200-day moving average was helpful from this entry point in 2003, and it was helpful all the way in to calendar year 2007, a fair question is, how does the same chart look today? This is the slope of the S&P 500's moving average as of the close on Thursday, April 13th. And we can see it really doesn't look anything like the low probability periods that we would like to avoid. Do we have anything from a short-term perspective that says it's possible that the market might resume the uptrend in relatively short order? Remember, I said possible. The answer is yes. We have a high equity put-call ratio, which can precede a turnaround in the market, and pessimism has been at or above average for the 9th straight week, the longest streak in nearly 5 years. These can be contrary indicators telling us to keep an open mind about better than expected outcomes over the next 5 trading days or so. In terms of looking at the evidence to see if our theory appears to be intact as of the close on April 13th, remember from a long-term moving average perspective, these are the looks, the early stage bear market looks with the primary trend rolling over that we want to avoid. This is the look of the 200-day moving average. This chart will remain the same from the close on April 13th through Sunday evening, April 16th. This is financials, 200-day, the base metals ETF, DBB, economically sensitive sectors with SP high beta as of April 13th. Small caps have a constructive look from a long-term perspective. Russia's been in the news lately, but the slope of the 200-day moving average as of April 13th still looks healthy. And the broad market using VTI in the ETF world has a nice slope to the 200-day as of the close on April 13th. We can look at these slopes that we have here and ask ourselves from a probability perspective, do they look more like a long-term uptrend, look more like a long-term uptrend, or more like a long-term downtrend? Some interesting facts about the present-day market. This is the long-term trend emerging markets divided by SP high beta. Emerging markets and India have been moving up in our stack rank, but INDA India still has some work to do from a long-term perspective relative to SP high beta. This is foreign stocks, including Europe, relative to the S&P 500 as of the close on April 13th, 200-day moving average. Risk off relative to risk on. This is the VIX relative to the S&P 500. Risk off, TLT, relative to risk on, SPY. This is the long-term trend in bonds relative to stocks as of April 13th. And this is gold miners, GDX, relative to the S&P 500. Based on the evidence that we have in hand from a long-term perspective, our theory is still intact. As we head into next week, it's always important to have that flexible, unbiased, and open mind so we can see when volatility to ignore shifts into volatility to respect. But maybe what is even more important is the discipline to remain emotionally centered so we can make rational decisions when the market is open and when the market is closed, when things are going well and when things are not going particularly well. The charts are useless without the discipline and patience piece of the puzzle. Probably only 1 in 500 people has the necessary discipline to be successful. From a discipline perspective, from Market Wizards, the essential element is having a core philosophy. Without a core philosophy, you are not going to be able to hold your positions or stick with your trading plan during really difficult times. You must fully understand, strongly believe in, and be totally committed to your trading philosophy. Why do we tend to cover the same topics over and over again in these videos? Because that core philosophy and not drifting from your core philosophy is incredibly important. And note the quote from the Market Wizard, somebody very, very experienced. He says, stick with your trading plan during really difficult times. That implies that really difficult times are part of the equation, and it's not if really difficult times will come, it's only a question of when. Since human emotions are basically what make it difficult to remain disciplined when things aren't going particularly well, let's take last week's example where we used percentages, and let's get even closer to our emotions, which is dollar signs and account balances. Let's assume we're going through the same exercise we did last week where we're moving from point A to point B, and we entered into IWM small caps in calendar year 2003, and the trend started to diminish and end in calendar year 2007. If we assume that same entry point here, and we assume that we invested $1 million into small caps, and obviously this is hypothetical. And remember, our goal is to try to capture as much of this gain as we can within reason and move from point A to point B. From an emotional perspective, if markets moved in straight lines and we could remove the volatility, it would be very, very easy to remain disciplined. You would look at your account basically every day and get positive feedback, because the balance would be increasing and it basically would never decrease. When you review trend following, it's easy to say, yes, I'd like to get a 72% gain. It's another thing to fully understand how you get from point A to point B. We invest $1 million. We feel good. We've made $185,000. Then the inevitable drawdown comes. It's easy to understand this drawdown when you're watching this video. It's much, much harder to understand the drawdown over the past few weeks when it's real money and the markets are open. The roller coaster goes back up. We're up 287,000. Drawdowns are a part of all long-term trends. 130,000 in the plus column, 362,000, and our profit drops on the next pullback to 231,000. These are emotional moves in here that make it very, very difficult to remain disciplined. But as you can see, if you're following the long-term trend, the discipline can pay off. And it's important to understand that the drawdowns can be tough emotionally and financially. But there's also a potential reward if we can stay with the long-term trend. So this is true on any time frame. It could be a calendar year, it could be a 3-month period, it could be a 3-year period. Trends always have givebacks and emotional and capital drawdowns. From an expectation perspective, are we saying that we're buy and hold investors from point A to point B when the long-term trend remains intact? Because we know that it was never my thinking that made big money for me. It was always my sitting. Got that? My sitting tight. If your portfolio moved from 1.5 million to 1.3 million, you could understand how this quote comes into play. I think investment psychology is by far the most important element, followed by risk control, with the least important consideration being the question of where you buy and sell. Let's focus on one portion of that quote, risk control. Setting proper expectations is a big part of being able to get from point A to point B. The market model is not a blind buy and hold model. There are numerous reasons that we might sell or cut back on a position. Obviously, if we have evidence of a primary trend change, then that becomes volatility to respect. We don't have anything like that today. So if we cut back on a position in the short run, the next few days or weeks, it would not most likely be because we have evidence of a primary trend change. However, risk control speaks to money management. It's extremely important to make sure you protect your capital so you can live to fight another day. Even in the context of a long-term uptrend, there are times where you need to cut back on your risk exposure to make sure you're properly protecting your principal. And in this example here, money management might have come into play numerous times with some positions. And we're always thinking about opportunity costs. So it's possible that we have a position that's still in a long-term uptrend, but the math tells us that from a probability perspective, there are better places to be. Another extremely important concept from an expectation perspective, and if we set the proper expectations, it's much, much easier to get from point A to point B. If risk control comes into the equation where we raise some cash to protect principal, but those chess moves are made within the context of an ongoing primary uptrend, it's extremely important to realize that if the market rights itself, that we will redeploy that cash very, very quickly when we have a primary uptrend and we don't have a big picture look that looks like the early stages of a bear market, which means we could use risk control on a Tuesday and we might redeploy that capital on a Wednesday or Thursday. Remember the quote from last week, do what is right, not what is comfortable. Sometimes it's uncomfortable to redeploy capital that quickly, but within the context of an ongoing trend, when the evidence improves, it's the right thing to do. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.